Welcome to today's Institutional Explainer. Today, we're stepping away from the retail noise and looking at the markets strictly through the lens of institutional order flow. We're running a top-down smart money concept analysis on gold, specifically the XAUUSD pair. In this briefing, we'll dissect the underlying macro catalysts, map the institutional footprints on the charts, and lay out an objective, risk-managed execution plan. Let's get right into it.
Here's our core thesis for today. Gold is approaching a major liquidity zone and, quite frankly, smart money is already positioning before the next expansion move. Listen, we aren't looking at basic retail support and resistance here. We're tracking liquidity sweeps, market structure shifts, and exactly where the heavy institutional volume is hiding out. But to understand where price is going, we first need to understand the fundamental forces driving it.
Section 1, Macro Context and Sentiment.
Before we even think about opening a chart, we have to understand the fundamental catalysts manipulating the board. The market is just a massive interconnected web, and right now, geopolitical shifts are pulling the strings. What we're witnessing is a geopolitical chain reaction. Reports indicate the US and Iran are nearing a 60-day truce agreement, which crucially involves reopening the Strait of Hormuz. For institutional analysis, the market impact is what really matters. This diplomatic easing immediately caused WTI crude oil to drop roughly 5.5%. So why does this matter for gold? Well, lower energy prices reduce inflation fears, which in turn gives the US Federal Reserve much more breathing room to potentially cut interest rates. When rate cut expectations rise, the US dollar weakens, creating the absolute perfect fundamental tailwind for gold.
You can see this domino effect playing out perfectly right in front of us. We've got the US dollar index, the DXY, dropping down to that 99.04 level. Meanwhile, West Texas Intermediate crude oil is breaking down below $91 a barrel. This sharp sell-off in oil is actively dragging down the dollar. For institutional traders, this divergence is the fundamental green light to start hunting for long setups on gold. The macro storm is officially set. Now let's look at how this translates to price action.
Section 2, Higher Timeframe Narrative.
To make sure we're swimming with the institutional tide, we need to establish the overarching structure. If we look at the 4-hour time frame, we've got a broader downtrend that has effectively hit pause. Price recently created a lower low near 44.65, but notice this aggressive, violent bounce. We're currently retesting the 50-period exponential moving average from below. While the macro structure leans slightly bearish, this sudden influx of buying volume tells us the narrative is actively shifting. Institutions are clearly stepping in.
So, where exactly are they driving the price? It all comes down to understanding liquidity. Just above those recent 4-hour highs, specifically right between the 4580 and 4600 levels, rests a massive buy-side liquidity pool. In simple terms, this is just a dense cluster of stop-loss orders from retail short sellers. Smart money uses these clusters as absolute magnets. They actually need this liquidity to offload their positions, meaning price is heavily incentivized to sweep this exact level.
Now, context is absolutely everything. On this broader 4-hour view, gold is still trapped within a larger descending channel. The upper boundary of this channel aligns perfectly with the 200-period moving average, creating a pretty formidable ceiling right around that 4650 mark. This tells us that while a short-term bullish liquidity sweep is highly probable, we've got to remain cautious of the overarching technical vulnerability near that 4650 level.
Section 3, Micro Mechanics, Lower Timeframe Order Flow.
Let's zoom in a bit and track the specific footprints of that institutional volume. Notice the stark contrast here. On the higher 4-hour time frame, the structure is hesitant, right? It's a paused downtrend waiting for confirmation. But drop down to the 1-hour and 15-minute time frames, and you're going to see aggressive, explosive bullish order flow. Price is riding completely above both the 50 and 100 EMAs. This misalignment is classic smart money behavior, masking their accumulation on the higher time frames while aggressively shifting momentum on the lower ones.
And there is the undeniable footprint on the 1-hour chart. We're looking at a massive institutional gap up, jumping straight from 45.15 all the way up to 45.64 right at the market open. Let me be clear, this isn't retail buying. This is pure institutional force breaking the previous market structure. In smart money concepts, we call this a bullish change of character, or CHACH. The market's intent has fundamentally shifted from sell side straight to buy side.
The psychology at play here is just fascinating. That massive gap left behind at 45.15, it's a psychological trigger. It creates a classic retail trap. You see, Retail traders spot that gap and immediately try to short the market, assuming price literally has to come down to fill it. But institutions know this. By keeping the price hovering high, they squeeze those short sellers, force them into a panic, and ultimately use their stop losses as the very fuel to drive the price even higher.
We can actually see this accumulation happening live on the 15-minute time frame. After that initial surge, price enters a very tight consolidation phase. Look closely at the candles touching the 50 EMA. They're printing these long lower wicks, these rejection pins. Every single time the retail market tries to push the price down to fill that gap, smart money steps right in and absorbs the sell pressure. They are heavily defending this level.
Section 4. Trade execution and risk scenarios.
Applying this institutional logic, let's build out an objective plan. Our primary focus is this high-probability buy setup. We want to trade alongside the dominant order flow, for sure. We're targeting an entry zone between 45.52 and 45.55, which allows for a minor pullback to mitigate the 50 EMA. Stop loss is strictly placed below the short-term support at 45.44, and we're targeting the 45.78 level, designed to sweep that exact buy-side liquidity pool we identified earlier. This gives us a really solid 1 to 2.5 risk-to-reward ratio.
But listen, we don't just enter blindly. We need strict execution conditions. Step 1, we wait for that specific pullback to our zone. Step 2, we need confirmation on the 15-minute time frame, either a bullish engulfing candle or a clear pin bar, proving institutions are actively buying. Step 3, target the 45.80 sweep. And crucially, Step 4, this entire setup is completely invalidated if the 1-hour candle closes below 45.40. If that happens, the thesis is wrong and we simply step aside.
We do also have a secondary medium probability sell setup. Now this is a counter-trend move, so it really only becomes viable after the buy-side liquidity at 45.80 is thoroughly swept. If price spikes into that 45.82 to 45.85 region, grabs the liquidity and then immediately rejects, well then we can look for a short position. The stop loss would be tight at 45.92, targeting a return to the 45.55 level, but again this is strictly a reaction to a confirmed liquidity sweep.
The ultimate takeaway from this explainer is simple. Trade alongside smart money, not against it. Stop trying to catch falling knives or blindly filling gaps. If you want more of this institutional-style gold analysis using smart money concepts and ICT methodology, make sure to subscribe to the channel. You can also open your trading account using the link in the pinned comment to follow our future market breakdowns and structured trading opportunities.
I'll leave you with this final thought as you hit the charts today. The trap is officially set and the footprint is clear. Will you have the discipline to wait for the pullback to the institutional entry zone, or will you jump in too early and become the very liquidity smart money is hunting for? Trade smart, and I'll see you in the next briefing.